Hi, good morning, everyone, and welcome to today's presentation on discovering 1031 Exchange. My name is Jeff Stechmann, the Eastern Regional Manager for Asset Exchange Company. Before we kind of get started, I just want to kind of let y'all know about today's presentation. Don't feel like you have to write every single thing down. Today's presentation is actually being recorded, and you will receive a link to today's recording if you want to refer back to any of the topics that we cover. And then some of the topics that we cover today, I have in just like single page PDF form. I'm going to email those out to everyone that's on the call today, because I find a lot of times if you have a client that has a 1031 exchange need, you really would love to have something to email over to them. And what I send you will be perfect. All right. You may want to pick and choose what PDFs you include in that email, but it'll be in a format that you could easily send out to a client at a future date. And then also, as far as questions go, I'm going to open the floor up to questions at the very end of the presentation. Because I find a lot of times if you do have a question, most often it'll be answered in an upcoming slide. But again, if not, then at the end is when we'll open the floor up to questions. There's a box on the right-hand side. Right there is where you want to type your question in. And then for those of y'all that are online today that are Florida realtors and getting the 2 hours of continuing education. Hopefully, when you registered, you gave me your correct Florida license number, real estate license number. I needed to have the SL or the BK included in the number, because the way it works is I have to manually upload each one of your individual license numbers along with the SL or the BK, along with your first and last name. I upload that manually to the state of Florida. So if you didn't provide that, please give it to me. I don't need your MLS number. I need your Florida real estate license number. So again, if you didn't get it to me, please send it over to me. Well, it looks like we had a few people join a few minutes late, so I'll go ahead and introduce myself again. Again, my name is Jeff Stechmann, the Eastern Regional Manager for Asset Exchange Company. Kind of give y'all some information about myself. I've actually been in the business. This is my 26th year. I did a lot on the title side of the business to get my start. I've done just about everything there is to do on the title side. I'm originally from New Orleans, so if you hear the accent come through, every now and then it rears its ugly head. But I'm based out of Tampa, Florida, and I've actually lived in Florida for 23 out of those 26 years. And as long as I've been doing this, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And hopefully we never have to experience those bad times again. Right now the real estate industry is just booming. I mean, it's been booming for probably at least since last year. And hopefully we can continue this pace at least until the end of the year. For everybody on the line today, right? Now let's talk a little bit about the company. If I can get my slides to cooperate with me today. Okay, yeah, again, we're Asset Exchange Company, and, we've actually been in business since 2006, and over the course of our existence, we've done about 40,000 1031 exchanges, so it's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, we're known as a qualified intermediary, QI for short. Now, some other terms you may hear people refer to as is an accommodator. Another common term is a facilitator, or just simply an intermediary. But most commonly, people call us QIs. And our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. We hold the proceeds from that sale, because the rule is the seller, the exchanger, can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. And we're going to talk about that in more details in the next few minutes. Now, just a word of caution about QIs. It's amazing in today's heavily regulated real estate industry that At least on a federal level, there actually is no federal agency that oversees what we do. So, exactly what does that mean? Well, what that means is anybody out there can be a QI. Okay, there's no type of requirement you have to have any type of E&O insurance. There's no type of requirement you have to have any type of bond. There's no requirements on where you hold the proceeds or the type of fund you hold the proceeds in. It's a really scary, scary thought when you sit down and think about it. So, if anybody on the line today is currently involved with a 1031 exchange, please, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. Now, great news when you deal with us, right? Well, we're actually based out of California. Our home office is in San Francisco, and because we're California based, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that franchise tax board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. We're subject to audit by that franchise tax board. There's guidelines on the financial institutions where we hold the proceeds. There's guidelines on the type of funds we hold the proceeds in. That's all overseen by that franchise tax board, which is great for anybody that deals with us in California, right? But anything that we do anywhere in the United States, because we do 1031 exchanges in multiple states, anywhere in the country, that franchise tax board has oversight in any file that we work on, all right? Because as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on, not just California property, but anything that we do. So you do have some assurances when you work with us. And then as far as our ownership goes, we're actually owned by two gentlemen. Now, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The whole reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we would actually provide free audit support. All right, we'd work hand in hand with the client's CPA, helping to defend the audit. And it primarily would be done by our tax attorney owner, Adam Skarsgård. So another great reason to deal with us. Now, let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has been around for close to 100 years. And it really started back in the 20s with farmers. And, back in those days, it was pretty simple the way exchanges worked. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm and he wanted my farm. So all he did is just swap farms. And again, it was really just that simple back in those days. But our modern day exchanges, kind of the format that we follow today, well, that was really started back in 1979. And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker, he lived in California, and he owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. So if anybody on the line today has ever heard of the term a Starker exchange, okay, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs and, they've been in the business, 40, 50 years. They still refer to a 1031 exchange as a Starker exchange. So again, you may hear that term pop up, but that's where it comes from. It comes from T.J. Starker's last name. All right. Now, when we talk about 1031 tax deferred exchange, well, that name is actually derived from Internal Revenue Code Section 1031. All right, and the code states this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, I know that's kind of a mouthful, right? Well, where the code states that property held for productive use in a trade or business, right? So you can sell any type of real property that you use in your trade or business. You can sell that in a 1031 exchange, and you can buy as a replacement any other type of real property that you use in your trade or business. Okay, I'll give you guys an example of maybe the way that could work. We did an exchange for a gentleman. Now, he owned a daycare, right? um, he was actually using that real property for his business, right? So he sold it in a 1031 exchange with his. And in his case, what did he buy as his replacement? Well, in his case, he went out and bought another daycare center because why? Because he was going to use that real property in his business. All right. So again, any type of real property that you use in your trade or business, you can sell that in a 1031 exchange, and you can purchase any other type of real property that you use in your trade or business. Right now, the next part of the code where it states for investment. Now, for investment, that might be something as simple as, let's just say you own a single family residential home and you hold that for investment. Well, how do you hold it for investment? What's a rental property, right? You can take that rental property, you can sell that rental property in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code, like kind property. So what exactly is like kind property? Well, like kind property is any type of real property that you use in your trade or business or that you hold for investment. Okay, you can sell that in a 1031 exchange, and you can replace it with any other type of like kind property that you use in your trade or business or that you hold for investment. All right, so just because you own that single family residential home, the home that you hold for investment, right? That rental property, when you sell that in a 1031 exchange, you do not have to replace it with another single family, all right? You can if you want, by all means, but you could even replace it with a condo, a townhome, a vacant land, a duplex, a fourplex, a commercial strip shopping center. You could purchase, you could buy a downtown commercial office building, one of the high rises in any major metropolitan city in the United States, okay? Any type of real property. It doesn't matter if it's residential or if it's commercial or commercial to residential, it's all interchangeable, okay? It doesn't matter if it's trade or business to investment or investment to trade or business. All of that is interchangeable as well, okay? Any type of real property will qualify. All right, and those properties can be located anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. All right, so if anybody on the line has ever heard of the term a like kind exchange, okay, that's where it comes from. It comes from that part of the code that talks about like kind property. All right, Florida Realtors. Um, the standard real estate contract that Florida Realtors use here in Florida, it's referred to as the FAR contract, right? There's already standard 1031 exchange language in the contract, right? It's in section 18 and it's item N. In the contract, they actually refer to a 1031 exchange as a like kind exchange. So again, that will pop up every now and then, that term like kind exchange, but that's where it comes from. It comes from that part of the code that talks about like kind property. All right, so why do investors exchange? Well, the single most obvious reason that we see investors exchanging is for tax deferment. All right, so typically when you sell real property, all right, if you have any gain in the property, all right, on average, about a third of whatever that gain is goes towards paying taxes, right? So the single most reason that we see investors doing 1031 exchanges is to defer those taxes. But what are some of the other things that we see? Well, the next item, I call it buy more property. So with exchanging, okay, one of the rules to exchanging is the property that gets purchased as the replacement property. That purchase price must be equal to or greater than whatever the sales price was in the property that was sold. right? So what an investor will do is by utilizing a 1031 exchange, by deferring those taxes, okay, they use that as leverage to go out and buy a better property, right? Hopefully, it's going to be a higher dollar property for them. And also, hopefully, it's going to be a higher income producing property because just think about it. If they don't have to cut the check for for the taxes when they sell that property by doing a 1031 exchange, it's just going to give them that much more buying power to go out and buy a better property. Again, hopefully it's a higher dollar property. Hopefully it's going to produce higher income for them as well. All right. What are some of the other things that we see? Well, diversification and management relief is another thing that we see investors using 1031 exchange for. So, with exchanging, you're not even limited to how many properties you can sell in an exchange or how many properties you can purchase in an exchange. You could sell one property and buy one property. You could sell one property. You could buy multiple properties. You could even sell multiple properties in an exchange and buy a single property or buy multiple. Okay, it doesn't matter. Again, I'll say it again. What matters in 1031 exchange? As long as what you're selling, you're using it in your trade or business or you're holding it for investment, and you got to replace it with property that you're going to use in your trade or business or you're going to hold for investment. All right, so here's an example of the way diversification and management relief. All right, geographic diversification is something that we see. Let's say I own a property, an investment property. Let's say it's located in California. Now, California has some of the highest property values in the entire country. Where our home office is in San Francisco, I think the average price per home or per property there is now actually exceeded New York City. It may be the highest in the entire country, or it's one of the highest. So I own that property in California, that investment property. I do a 1031 exchange, okay, defer my taxes, but the replacement property that I purchase, instead of buying a replacement property in California, I say, well, maybe I'll buy one replacement property, let's say somewhere here in Florida. Maybe I'll buy a second property, maybe somewhere, let's say in Texas, and I don't know. Maybe I'll buy a third replacement property, let's say somewhere in Ohio. Because why? Because I don't want to be so tied into one particular real estate market because, hey, who knows? If our market here in Florida starts to go down again, well, at least I have that other property in Texas and I have that additional property in Ohio, right? Hopefully those markets would not be experiencing the same downturn that we would be experiencing here in Florida, all right? Management relief, all right, is something else we see investors utilizing 1031 exchange for. I'll give you guys another example. I have a guy, all right, he lives in New York. He owns 4 rental properties, okay? Now, what he'd like to do is he'd like to retire and he'd like to move to Florida. But you know what? He doesn't want to manage property anymore. So ultimately what he'd love to do is he'd like to sell all 4 of those rental properties in one 1031 exchange, okay? And he'd like to buy maybe like a small apartment complex somewhere here in Florida that has some on-site management. Because again, why? Because he doesn't want to manage property anymore. Basically, he wants to retire and he wants to sit back and he wants to collect a check every month. So 1031 exchange is perfect for somebody like him. All right. Now, what are some of the other things we see? Well, one other thing it's really a really great aspect of 1031 exchange that it doesn't get talked about that often, but if you don't remember anything other than this next point from today's class, remember this, okay? Investors will actually use 1031 exchange as an estate planning tool, okay? Because with exchanging, you're not even limited to how many times you can do a 1031 exchange, okay? I could buy an investment property today, like a rental property, let's just say, hold on to that for a period of years. At some point, when I go to sell it, I do a 1031 exchange, I defer my taxes, and I buy another replacement investment property, hold on to that for a period of years, sell that again in another 1031 exchange, defer my taxes again, and buy another replacement investment property, okay? And I can keep doing that over and over and over throughout the course of my entire lifetime. Okay, now here's the great part of a 1031. When I die, if I have any heirs that inherit my property, my heirs are going to get a benefit that's referred to as a step up in basis. All right, and basically what that means is whatever the value of the property is when they inherit it, that's going to be their basis. That's their starting point. All of those deferrals that I would have done over the course of my lifetime, basically they go away and no one ever has to pay the taxes. All right. So again, it's a really great aspect of 1031 exchange, the step up in basis for your heirs. That again, it doesn't really get talked about that often. Okay. Now, here's the flip side of that. I just mentioned you're not limited to how many times you can do a 1031 exchange, right? Buy an investment property today, hold on to it for a period of years, sell it in a 1031 exchange, defer my taxes, buy another investment property, right? Hold on to that for a period of years, sell that in another 1031 exchange, and buy another replacement investment property. Now, let's just say the next time I go to sell, I say, you know what? I have no desire to buy any more investment properties. I'm just going to cash out. I'm not going to do a 1031 exchange. I'll cash out and pay whatever taxes are due. Well, I'm going to be responsible for whatever taxes are due on that sale. And all of those previous 1031 exchanges where I deferred my taxes, I'm also going to be subject to having to pay those taxes as well. All right? Because with 1031 exchange, remember, it's not a tax avoidance, folks. It's a tax deferral. Deferral meaning that you may have to pay the taxes someday if you do not continue to do 1031 exchanges. But remember the step up in basis, right? If you have heirs that inherit your property, they're going to get that step up in basis, and hopefully no one ever has to pay the taxes. Okay, so again, hopefully everybody remembers that from today's presentation, the whole step up in basis. I'll give you an example real quick of how the step up in basis could possibly work. Okay, let's say I'm the heir. Okay, I inherit the property. Now, for my investment purposes, right, it may be, I may look at it and say, that's a great property. Now, I get the step up in basis, right, where I'm not responsible for paying any of the taxes. All right, so the taxes go away. But the actual property itself, I may look at that property and say, wow, this is a great property, right? Maybe it has some nice cash flow coming in every month. I'm not going to sell it. I'm going to hold on to it for my investment purposes. So let's just say I hold on to it for, I don't know, maybe 5 years. And then after 5 years, then I say, okay, now I'm ready to sell the property. Now, if I have any gain from when I inherited it, where I got that step up in basis, to when I go to sell it 5 years later, guess what? I can do my own 1031 exchange and defer my taxes and basically start the whole process over again. All right. So again, everybody remember the whole step up in basis. Again, it's a really great aspect of 1031 exchange, especially for us that live here in Florida, right? Because we have so many people that retire, move to Florida, they own investment properties, right? Again, it's a great aspect. All right, now let's talk a little bit about what current tax rates are. So when you sell real property, right, if you have any gain in the property, you're going to be subject to capital gains taxes. Now, capital gains taxes right now are either 15 or 20%. Now, the 15%, historically, it was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you were at the 15% capital gains tax rate. Now, the 20% capital gains tax rate was applied historically if you were single and you had income of greater than $400,000 a year, or if you were married, you had income of greater than $450,000 a year. Now, the reason I'm saying historic, because I think the income levels have risen just a bit in the last tax reform bill that passed a few years ago. But still, any way you look at it, you're going to be looking at either 15 or 20% capital gains taxes. Now, on top of that, you may also be subject to what they refer to as depreciation recapture tax. Okay, that's an additional 25% tax. Now, what is that all about? How does that work, right? Well, the depreciation recapture tax, it works like this. Any depreciation that you've claimed in the property, all right, for the lifetime that you've owned the property, right, when you go to sell the property, they're going to hit you with a 25% tax on the entire amount of depreciation that you've claimed for the lifetime that you've owned the property. All right. Again, it's referred to as depreciation recapture tax. Now, on top of that, you may also be subject to what they refer to as the Medicare tax. All right. That's an additional 3.8% tax. Now, what is that all about, right? Well, the Medicare tax, that was actually passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act, right? So when you do a 1031 exchange, you can defer having to pay any of these taxes. Now, what am I not listing on the slide? I'm not listing anything to do with state income taxes, right? Now, for those of y'all on the line today that are located here in Florida, like I am, right, we don't have state income taxes, so we don't need to worry about that. But if we live in a state, or even if we're selling property that is located in a state and that state has state income taxes, we would also be subject to having to pay state income taxes. Now, the good news is when you do a 1031 exchange, you can also get out of having to pay those state income taxes. Right now, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. All right, I'll give you guys a couple of examples that I was actually involved with. Well, we had a gentleman. Now, he was a Florida resident, okay, but he was selling property that was located in California, all right, an investment property. Now, California has state income taxes. Now, their state income taxes, I think, can be as high as like 11 to 12%. It's something like that. It's like a tiered level. But the good news for him was because he was doing a 1031 exchange, he was able to get out of having to pay those state income taxes, right? Even though he was a Florida resident, it didn't matter to California, right? They still wanted their state income taxes, all right? Even though he was a Florida resident. But again, he was doing the 1031 exchange, so what they required him to do to get out of having to pay those state income taxes was he had to complete this form, the state of California form. He had to submit it to the state, and that's how he got out of having to pay the state income taxes. Now, it's my understanding that he's got to submit that form every year thereafter. The year he doesn't submit the form, they actually come after him for the taxes. All right. Now, we did another exchange. It was for a lady. She was another Florida resident, but she was selling property. I believe it was in Maryland. All right. Now, Maryland has state income taxes as well. What they required her to do to get out of having to pay them because she was doing a 1031 exchange, is she had to complete this state of Maryland form. We actually had to sign off on it, and I think she had to get it to the state of Maryland. It was like I think it was like 21 days prior to closing, and that's how she got out of having to pay the state income taxes for Maryland. So again, every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes. All right, now realtors on the line, y'all think about this for a minute, right? If that's your client, okay, and you know they're selling an investment property and they're not talking about doing 1031 exchange, right? Well, that's a perfect opportunity to bring it up to them, right? Especially if they live in a state or they're selling property that's located in a state that has state income taxes. Because why? Because it's even more to their advantage to do a 1031 exchange, because they're going to be able to save on defer having to pay any of the taxes for the federal taxes, right? But also they would be able to get out of having to pay any of those state income taxes as well, right? By doing a 1031 exchange. And if they don't have to cut that check or those checks before the federal and also for the state, it's just going to give them that much more buying power, right? Now they can go out and they can find a better property. Hopefully it's going to be a higher dollar property. Hopefully it's going to produce higher income for them. And what is that going to do for you as a realtor? Hopefully you're going to increase your commissions, right? Because if they can buy a higher dollar property, what does that equate to? Hopefully that equates to a higher commission for you. Okay. Florida realtors. Hey, sometimes, because we live in Florida, we have so many people that want to move here or at least buy property here, investment property. Again, sometimes you may not even be involved with the listing side of it, right? You might be helping that investor find some replacement property. Again, if they're not talking about doing a 1031 exchange, it's a perfect opportunity for you to bring it up to them. Okay, so some things to think about for everybody on the line today, right? Now, Let's talk a little bit about how do you calculate what the taxes are. So this is actually done by typically done by a CPA. All right, but I'm just going to walk you through a really quick example just to kind of give you an idea of what potential taxes could be. All right, so in our example, we originally purchased our property for $500,000. Right now, over the lifetime that we owned the property, we added back in $25,000 worth of capital improvements. All right now, we took some depreciation. Okay, for the lifetime that we owned the property, we actually took $100,000 worth of depreciation. Okay, and now we're going to sell the property. We're going to sell it for $1 million. Right. So in order to calculate what the taxes are, the first thing you need to do is you have to be able to calculate what they refer to as adjusted basis, right? And the way you do that is you take the original purchase price of $500,000, you add back in the $25,000 worth of capital improvements, and then you deduct out the depreciation of $100,000, right? And that's going to give you an adjusted basis of $425,000. Now, how much are we selling it for? Well, we're going to sell it for $1 million, right? So we'll take that $1 million sales price, we'll deduct out the adjusted basis of $425,000, and then that would give us a gain of $575,000. Now, how much of that was depreciation? $100,000, right? We're going to take that $100,000 out of that number because the depreciation recapture tax, that 25% tax, that's actually calculated at a separate line item, right? So we'll take the $100,000 depreciation out, multiply that times the 25% depreciation recapture tax, and that will give us a tax of $25,000. Now, let's just say we're at the highest capital gains tax rate of 20%, all right? So we'll take the 20%, we'll take the remaining amount, the $475,000, we'll multiply that times the 20% capital gains tax rate, and that would give us a tax of $95,000. Now, let's also say we're going to be subject to that Medicare tax of 3.8%. All right, so we'll take the $475,000, multiply it times the 3.8% Medicare tax, and that would give us a tax of $18,050. All right, so when we sell this property, we would be looking at a tax bill of $138,050. All right, again, when you do a 1031 exchange, you can defer having to pay any of these taxes. All right, now, what am I not listing on the slide? Again, I'm not listing anything to do with state income taxes, right? So again, if we live in a state or are selling property in a state, we would also have to calculate that number, whatever that number equates to. All right, again, realtors, think about it. If that's your client, right, and they're looking at having to cut a check for $138,050, right? And then whatever's left over, hey, now let's go out and find me some replacement property. Again, if you're the one that brings it to their attention, you say, hey, look, that check you're going to have to cut for $138,050, do a 1031 exchange, defer all those taxes. Now let's go out and find you something even better, right? Well, that's win-win for everybody, right? The client's going to win because why? Hey, they save on the taxes, right? And also, they win because, hey, now if they have that much more to use to go out and buy a better property, well, hopefully it's going to be a higher dollar property and hopefully it's going to produce higher income for them. And you win as a realtor because why? Hey, you look great to the client, right? And also, hopefully, you just increase your commissions because, again, hey, if they can buy that higher dollar property, hopefully you just increase your commissions, all by recommending a 1031 exchange. All right, so again, some things to think about for everybody today, right? Now, what are some of the tax advantages when you sell real property? So let's recap again. 1031 exchange, all right? You can sell any type of real property that you use in your trade or business or that you hold for investment, all right? And it's a tax deferral, right? It's not a tax avoidance. Tax deferral meaning that, hey, you may have to pay it someday if you don't continue to do 1031 exchanges, right? But again, remember that whole step up in basis, right? If you have any heirs that inherit the property, hey, they're going to get that step up in basis, and hopefully no one ever has to pay the taxes, right? Now, what about your primary home? Can you do a 1031 exchange on your primary residence? And the answer is no. Okay, for your primary, you may qualify for what they refer to as a Section 121, right? And the rules for that, or the guidelines for that, are you had to have lived in the property any 2 out of the last 5 years as your primary residence, okay? If you have any gain in the property when you go to sell it, okay, and you're single, the first 250,000 of any gain is tax exempt, and if you're married, the first 500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it, right? You never even have to worry about it after the fact, right? Not like a 1031 exchange where you may have to pay it someday, but with the exemption, it's a one-time exemption, right? You don't need anybody like me to help you with a 121, right? That's just something that you claim on your tax return, okay, in the year that you sell your primary home, your primary residence, okay? Now, here's an example of where the 121 can work. Let's say back in 2010, all right, we go out and we buy our primary residence, our primary home. Now, we're going to buy it for $100,000. Now, we're going to live in it for 5+ years as our primary, okay? And then in 2016, we're going to sell it, all right? Now, we're going to sell it for $1 million. Now, I know, everybody, that was a great deal, right? We bought it for $100,000 and we're selling it for $1 million. You know, I don't know if there's any deals like that anywhere here in the Tampa Bay area where I live. I don't know. Maybe this is property in New York or California, right? But for our example, we're just going to keep the numbers really simple, right? So we're selling it for $1 million, right? We bought it for $100,000. Well, our gain's $900,000. Now, I know that's not exactly how you calculate it. We just talked about adjusted basis and everything else. But again, for the example, let's just keep it really simple. All right. So we have a $900,000 gain. Now, it qualifies for 121. Okay. Let's just say when we sell it in 2016, we're married. Okay. So we're going to claim the 121. So the first 500,000 of the 900,000, because we're married, okay, that portion is going to be tax exempt. But what's the problem? Well, the problem is we still have another $400,000 worth of gain that we're going to have to pay in taxes in 2016 when we sell the property. That's going to equate to roughly about $130,000 in taxes when we sell the property in 2016. Now, what if we could do this? What if we could take that property and we could convert it over to an investment property? Let's just say it's a rental property, okay? So in 2016, we actually converted over to a rental property, and then we rent it out for 2 years, okay? Now we're going to sell it in 2018, okay? Now, let's keep all the numbers the same, all right? We're still going to sell it for $1 million. We're still married. But because we're selling it in 2018 and it's now an investment property, it qualifies for 1031 tax-deferred exchange, okay? We can actually do a combination of a 121 and a 1031, all right? The guidelines for that are you had to have owned it for at least 5 years. You had to have lived in it, again, as your primary, any 2 out of those 5 years, all right? So, again, we still have that $900,000 gain. So what we're going to do is we're going to claim the 121, all right? And again, we're married, so the first $500,000 of the $900,000 gain will be tax exempt, all right? Now, that additional $400,000 of gain, we're back in 2016, we're having to pay taxes on it if we would have sold it. Well, now we're going to claim a 1031 tax-deferred exchange on that portion of the gain, and we're going to defer that portion of the gain, the taxes, all right? So in 2018, when we sell it, we pay no tax, all right? Pretty cool, right? Now, here's another way you could even do it. Let's say you go out, let's say you want to buy a fourplex, all right? One of the units, you actually want to live in it as your residence, as your primary home, okay? But the other 3 units, you want to rent those units out. That's going to be the investment portion of it, okay? Again, when you go to sell that property, did you own it for 5 years? Did you live in it for at least any 2 out of those 5 years? If you did, you can do the combination where 1/4 of the gain, okay, you claim the 121, that portion would be tax exempt, and then 3/4 of the gain, you claim a 1031, and that portion will be deferred. You do the 1031 exchange on that portion of the gain, and then you pay no taxes when you sell it. The same thing could work, let's say, if you own a duplex, all right? You want to live in half as your primary, but the other half you want to rent out. Same thing. When you go to sell it, did you own it for 5 years, live in it for 2 out of the last 5, any of those 5 years? Again, in that case, let's just keep it simple. Half of the gain, you claim the 121. The other half, you claim the 1031 and defer that portion and pay no taxes. All right. So pretty cool, right? Of how the 121 and the 1031 can work. All right. Now, I get this question pretty often. People will ask me, say, well, Jeff, how long do I need to own a property for it to be considered an investment property? And the honest answer is, I don't know, all right, because there's nowhere in the code that states how long you need to own a property for it to be considered an investment, all right? It just says that, hey, you need to own the property for your trade or business, or with the intent, or for investment, all right? But if you ask some CPAs, okay, they'll tell you a good rule of thumb is really to hold on to their property for at least a year, for 12 months. All right, and if you think about the logic behind that, just for a minute, let's say you do your deal this year. Okay, you buy your investment property this year, your rental property. Keep it simple, right? Now remember, you're going to own it for a year, for 12 months. So you're going to claim that property as an investment property on your 2021 taxes, right? So any income that's coming in off of rents, right? Any expenses that are going out, you're going to report that on your 2021 on taxes, right? Now, you remember, you're holding it for a year, for 12 months. You're also going to claim that property as an investment property in your 2022 taxes, right? Again, any income that's coming in, any expenses. That's actually reporting that property as an investment property over 2 tax filing years, right? 2021, 2022. That's showing that to the IRS that property is an investment property, right? Now, some other CPAs will tell you, no, a good rule of thumb is you really need to hold on to it for at least 2 years, for 24 months, all right? One of the reasonings behind that is, we're going to talk about it in the very next slide, okay? Back in 2008, the IRS came out with guidelines regarding vacation homes, right? And in the guidelines for vacation homes, the IRS stated for a vacation home to be considered an investment property, you must own the property for a minimum of 2 years or 24 months. All right. So some CPAs pick up on that and they say, well, for vacation homes, the IRS is actually giving us guidance for that vacation home to be considered an investment property. You must own it for at least 2 years or 24 months. Therefore, any type of investment property, a good rule of thumb is to hold on to it for at least 2 years or 24 months. But, the reality of the way the whole thing works is, it's not so much about how long you own a property, okay? It's more so about your intent. And your intent could be something like this. Did you advertise the property for rent? Okay, did you advertise it for fair market value rent? If fair market value rent is, let's say, $1,500 a month, and you are advertising it for $5,000 a month, you know what? The IRS is probably going to have an issue with that, all right? If you get audited and the IRS comes in and says, prove to us you held that property for investment, you're going to have to be able to back it up, okay? I list one particular court case on the slide. It's referred to as Resnick versus the commissioner, all right? In that particular court case, the circumstances was, you had a husband and wife, all right? They owned a single-family residential home, and that was their primary home, okay? They also owned another single-family residential home that was an investment property, all right, a rental property, right? So what they did was they sold the rental property, the investment property, in a 1031 exchange, okay? Now, the replacement property that they purchased was another single-family residential home. That was going to be the new investment property, okay? Now, during the 6-month period after they did their 1031 exchange, okay, they actually advertised the new investment property for rent. They ran a classified ad in the town newspaper that they lived in, advertising it for rent for fair market value, okay. They actually showed it to 2 potential renters during that 6-month period, but for whatever reason, okay, they could never get the property rented out. All right. Now, what else happened during that 6-month period is one of them loses their job. Okay. So they had a mortgage on their primary home. They also had a mortgage on that investment property. But what? That property wasn't rented out, right? So after 8 months of ownership, they wound up selling their primary and they moved into the investment property. Okay, in that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? Well, their circumstances changed, right? And they were forced to do something. So again, it's not so much about how long you own a property. Okay, it's more so about your intent. And as I mentioned, if you get audited, okay, you're going to have to be able to prove it. All right, so everybody remember that investment intent. Okay, now, vacation homes. I always like to talk about vacation homes, especially because I'm located here in Florida, and I know we have a lot of realtors on the line that are also located here in Florida. And in Florida, everybody has a vacation home, or it seems like everybody wants a vacation home, right? So, how does that vacation home qualify as an investment property? So this is actually referred to as Revenue Procedure 2008-16. And the first guideline I've already given you guys, okay? You must own that property for a minimum of 2 years or 24 months, right? Now, for every 12-month period of ownership, okay, you must rent the property out for a minimum of 14 days at fair market value, okay? Now, you can use it for some personal use, okay? For every 12-month period of ownership, you can actually use it for 14 days personal use or 10% of the total time that it was rented during that 12-month period. So I'll give you guys an example of maybe the way that could work. Let's just say during that 12-month period, okay, you actually rented the property out for 200 days, okay? So 10% of 200 would be what? Would be 20, right? So you could use the property for 20 days personal use instead of the 14, all right? If that property meets those guidelines, it qualifies as an investment property. And hey, you can use it in a 1031 exchange. All right. Now, if it doesn't meet those guidelines, all right, I wouldn't necessarily say it would be disqualified. In that particular situation, I would recommend to the client, I'd say, look, talk to your CPA. Okay, and if you and your CPA can come to an agreement where you feel like you can justify that property as an investment property, then hey, by all means, use it in a 1031 exchange. Okay, we're always going to recommend to people talk to your CPA. Because why? Because your CPA is going to have way more information about your tax situation than I ever would, okay, that I would even ever want to know, right? If the CPA comes back and says, yeah, I feel like we can make the case that it's an investment property, then you know what? We move forward with it. Use it in a 1031 exchange, okay? Remember, everybody, I talked to y'all at the very beginning. I said, hey, I have some information I'm going to send out to everybody. Some of the topics we're going to cover today, I have in PDF form. I have one that talks about vacation homes. So again, I'm going to email those out to everybody on the line today. Just be on the lookout for it, okay? Now, who can actually do a 1031 exchange? All right, so with exchanging, all right, whoever the taxpayer is in the sale of the relinquished property, okay, that's the property being sold in a 1031 exchange, needs to be the same taxpayer in the purchase of any replacement property or properties. All right, so individuals can do 1031 exchanges. Husband and wives can do 1031 exchanges. Spouses can do 1031 exchanges. Now, sometimes we see this with spouses. Let's just say one of the parties owns an investment property prior to being married. Okay, let's just say it's the wife. Okay, so she owns an investment property, a rental property, right, prior to being married. Now, she gets married. Okay, and then during the course of the marriage, she decides she wants to sell that investment property. She wants to sell that rental property, and she wants to do a 1031 exchange, all right, because she wants to defer her taxes or whatever taxes are due, all right? Now, she wants to buy another investment property, a new replacement investment property, a new rental. But the problem is she needs to get a loan to help her buy that replacement property. And in order to qualify for the loan, she has to bring her husband in because she needs his income to qualify for the loan. All right. So how can you do that with 1031 exchange, right? Well, one possible solution would be you could possibly take title to the replacement property is what they refer to as tenants in common. All right. Now, tenants in common ownership, it's for hopefully everybody knows what it is, but if you don't, all right, it's pretty simple. You can actually own a certain percentage of a property. All right. Now, in order for any of this to work, you'd have to get the lender's approval. Okay. Because what you might be able to do is you might be able to take the wife, make her a 99% tenant in common owner of the replacement property, and then you bring the husband in and you make him a 1% tenant in common owner. Again, if the lender would go for those terms, then hey, you could get the loan and you could move forward buying the replacement property. All right, that brings me to the next point. Tenant in common owners can do 1031 exchanges as well. All right, I'll give you all an example of maybe the way that could work. Let's say I want to go out and I want to buy an investment property. All right. But I want to bring somebody else in with me to help me purchase it. All right. Now we're going to purchase the property as tenant in common owners, where I'm going to own 50%. Okay. And he's going to own 50%. All right. So we buy this investment property together, 50-50, tenant in common owners. Right. Now we hold on to it for a period of years. Okay. Now at some point we say, okay, well, now we're ready to sell it. All right. Now for me, I'd like to take my 50% tenant in common ownership, and I'd like to do a 1031 exchange because I want to defer my taxes, and I'd like to go out and buy a replacement property. Now, my other tenant in common owner, he says, you know what? I have no desire to purchase any more replacement property, any more investment properties. Okay, I'm fine with just cashing out and paying whatever taxes are due. Okay, well, he has the option to do that. Okay, and I also have the option to do what I want to do. Right, if I want to do a 1031 exchange because I want to defer my taxes and I want to buy a replacement investment property, I can do that. And you know what? He could do that as well. If he wanted to do his own 1031 exchange on his 50% tenant in common ownership, defer his taxes, he could go out and buy a different replacement investment property. Okay, so tenant in common owners, again, can do 1031 exchanges. Any type of legal entity that owns real property can do a 1031 exchange. Okay, corporations, partnerships, trust, LLCs. Okay, sometimes we see this with LLCs. People will create an LLC, and for tax purposes, it's going to be a disregarded entity. Now, disregarded meaning that you don't file a separate tax return for that entity, for that LLC. All right, you just put anything to do with that entity, that LLC, on your personal taxes. All right, it's common where people have maybe like a single member LLC. Okay, some of y'all on the line for your real estate business, right? You might have your own LLC, and what do you do at the end of the year? Well, you don't file a separate tax return for that LLC, right? Anything to do with that LLC, you just put on your personal taxes. So again, that's referred to as a disregarded entity because that LLC, that entity, and you as an individual are considered one and the same for tax purposes. Because why? Because it's all being reported under one tax return. Okay, so with 1031 exchange, if you own an investment property as an individual and you sell that in a 1031 exchange, you have the option to purchase the replacement property in your name as an individual, or you could actually buy the replacement property in your disregarded entity, your disregarded LLC. Because again, why? Because it's all considered one and the same for tax purposes, right? Sometimes we even see this with investors. Let's say they go out and they want to buy 1234 Main Street. Okay, so what do? They create 1234 Main Street LLC. Now this is an investment property, right? But they purchase it in the name of 1234 Main Street LLC. Well, 1234 Main Street is going to be a disregarded entity, meaning what? They're not going to file a separate tax return for that LLC. Anything to do with that LLC, they're just going to put on their personal taxes, right? So they buy that property, they hold on to it for a period of years, and then at some point they say, okay, I'm ready to sell it, and I'm going to do a 1031 exchange because I want to defer my taxes. And they want to go out and they want to buy as a replacement property. Let's say they want to buy 5678 Central Avenue. Well, guess what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? They go out and create 5678 Central Avenue LLC that is also going to be a disregarded entity, meaning what? They are not going to file a separate tax return for that entity as well, right? They can do that as well, folks, because why? Because all of those disregarded entities are considered one and the same with each other, and they're also considered one and the same with the individual. Because why? Because they're all being reported under one tax return. Right now, if it's a regarded entity, meaning that the actual entity itself files a separate tax return, then if that entity is the seller, that regarded entity is the seller, that same entity needs to be the purchaser in any replacement property or properties. Okay, if all of us on the line today, let's say we're all involved in a partnership. Okay, let's say we own a building, all right? It's an investment property. We own a building, all right? Well, the partnership, okay, files a separate tax return. And typically what the partnership will do is issue K-1s to all of the partners, right? Well, if that partnership sells that building and does a 1031 exchange, the partnership's going to have to go out and buy the replacement property. Okay, we could never try to buy replacement property as us as individuals, because why? Because we don't actually own it, right? The entity does, the partnership does. So always remember that with 1031 exchange, whoever the taxpayer is in the sale, okay, needs to be the same taxpayer in the purchase of any replacement property. Okay. Sometimes we see this with partnerships. Sometimes when a partnership sells real property, let's say they have an investment property, when they sell that property, okay, sometimes the individual partners may have different ideas of what they think the partnership should do. All right. You may have one partner that says, well, I think on the sale of the investment property that the partnership owns, I think the partnership should do a 1031 exchange to defer the partnership's taxes, and I think the partnership should buy another investment property. All right. You may have another partner that says, you know what, I don't think we should do any of that. I don't think we should buy any more replacement properties. Have the partnership buy any more replacement properties. I think we should just not do a 1031 exchange and pay whatever taxes are due. Okay. Well, how can you satisfy both of them, both of those partners' goals? Well, here's two solutions. Okay. Now, these are actual terms that we use in the industry. Okay. The first one's referred to as a drop and swap. All right. So here's how it works. Let's say we have a partnership. Now, we'll keep it simple. Let's say we have 3 members in the partnership, all right? The partnership owns real property, owns an investment property, all right? So the drop portion of the drop and swap works like this. The actual partnership itself will be dissolved. That's the drop, okay? And what they do is they change the ownership structure of the property. They change it over to tenants in common. Okay, so we said we had 3 partners, right? So the former 3 partners each become a 1/3 owner in that property. Okay, now as tenant in common owners, okay, they're going to have to hold on to the property probably for a year or two. Because why? Because they need to show as tenant in common owners that their intent is to hold the property for investment. All right, now after the year or two passes, then they can do the swap. Then they can sell the property. Okay, that's the swap portion of it. They can sell the property. Then each individual tenant in common owner can do what they want. Hey, one wants to do a 1031 exchange, defer the tax, buy in a replacement property, no problem. You have another tenant in common owner. That tenant in common owner wants to just cash out, pay whatever taxes are due. They can do that as well, okay? But it's going to take some time, right? It's going to take a year or two before it's all over and done with, right? Now, the opposite of a drop and swap is referred to as a swap and drop, okay? Here we go. This is how it works. An example, let's say we have that 3-member partnership again, right? Owns the real property. So the swap portion of the swap and drop works like this. The actual partnership itself will sell the property, and the partnership does a 1031 exchange. All right. Now, the replacement property that the partnership goes and buys, instead of buying 1 replacement property, the partnership will actually buy 3 replacement properties. Now, why 3? Because why? Because we have 3 partners, right? And the thinking is each partner is going to have a say in what property the partnership buys. Okay, so the partnership buys 3 replacement properties. Now the partnership is going to have to hold on to those 3 replacement properties probably for a year or two. Because why? because the partnership needs to show that it's holding those 3 replacement properties with the intent for investment. All right. And then after the year or 2 passes, then they do the drop. Then they dissolve the partnership, and then each former partner will get one of those properties. Okay, with either one of these scenarios, these examples, right, it's going to take some time. It's probably going to take a year or 2 before everything is over and done with, right? The partners have to have some type of agreement or willingness to work with each other for the next year or 2, right? Unfortunately, sometimes with partnerships, the whole reason the partnership wants to sell is because they can't stand each other, okay? They want to get away from each other. So again, there has to be some type of agreement or willingness to work with each other for the next year or 2 before everything's over and done with. All right, so drop and swap and swap and drop. All right, now I get this question. I think I got it yesterday, actually. Can foreign sellers do 1031 exchanges? And yes, they can. Okay. Foreign sellers, that's foreign individuals, foreign entities. I believe also foreign sellers are considered, even if you have a U.S. company. I had a guy a few years ago call me. He had a U.S. company. He was a U.S. resident. One of his partners was a foreign individual. That was considered a foreign seller. Okay, foreign sellers are subject to an additional tax. All right, it's referred to as FIRPTA. All right, the FIRPTA tax is an additional 15% tax, and it's based off of the gross sales price. Okay, when a foreign seller does a 1031 exchange, okay, they can actually get out of having to pay the FIRPTA as well. Okay, now there's a form that needs to be completed. What the IRS will do is they'll actually issue an exemption certificate for that particular transaction. Okay, it doesn't happen overnight, folks. All right, it's the IRS. It can take anywhere from 6 to 8 weeks for them to issue this exemption certificate. All right, you have to have a tax ID number. If you don't, you have to apply for one. All right, you have to complete the form requesting the exemption certificate. Again, it doesn't happen overnight. All right, I have a PDF flyer that talks about just the FIRPTA information of how to go about getting that tax exemption form, the whole process. All right, I'm gonna send that out to everybody. One of the other things that can affect the FIRPTA, how can someone get out of having to pay it? If the purchase price is $300,000 or less, okay, and the buyer of that property is going to live in the property as their primary, then there's no FIRPTA withholding. All right, if the sales price is anywhere from $300,000 up to $1 million, and the buyer is going to live in it as their primary, there's only a 10% withholding. Now, if it's $1 million or more, it doesn't matter either way what the buyer is going to do. It's still the 15%. All right, typically with 1031 exchange properties, those investment properties, typically the buyers of those properties, the properties that we see investors selling, typically the buyers, they're never going to live in the properties as an investment, as their primary. They typically are other investors, and they're buying it as an investment. All right. So again, I have a PDF I can send out to everybody. I'm going to get it out to you guys, and it talks about the FIRPTA withholding. All right. Now, related parties in 1031 exchanges. All right. If you're going to sell to a related party, or you're going to be purchasing a property from a related party, you need to be really, really careful when it comes to 1031 exchange. Okay, related parties, that's like your spouse, your kids, your grandparents. If you own 50% or more in an entity, that's considered a related party. All right. There's a part of a form that I list on the slide here. That's actually part of IRS Form 8824. Okay, that's the form that your CPA completes or you complete. Okay, you include that on your tax return. That's how you report your 1031 exchange on your income tax return. All right, on that form, they specifically ask, did you buy from a related party or did you sell to a related party? Okay, the IRS is looking for that. All right. The IRS is looking for an arm's length transaction when it comes to 1031 exchange. okay, you can only buy from a related party if that party is also doing a 1031 exchange, right? You can only sell to a related party if that party holds the property for at least 2 years. So again, you just need to be really careful. Anything to do with the related parties, you have to dot every I, cross every T. If they're looking for that on the form, it could possibly trigger some type of audit. All right, so just keep that in mind. Anything to do with related parties and 1031 exchange. All right. Now, the most important slide of the day. I know this is why every realtor on the line today is attending, because why is exchanging beneficial to you guys as realtors? Okay. Well, for one thing, with 1031 exchange, right, there's always going to be two transactions, right? There's always going to be the sale of the relinquished property. Okay, that's a property being sold in a 1031 exchange. And there's always going to be a purchase of a replacement property. All right. Two transactions. What does that mean for you guys as realtors? Two transactions, two commissions, right? Now, one of the rules to 1031 exchange, okay, the replacement property that gets purchased in a 1031 exchange, right, that purchase price must be either equal to or greater than whatever the sales price was on the property that was sold, the relinquished property. So what does that mean for you guys as realtors? That means is what that means is the commission that you're going to make on the replacement property. Well, that's going to be as good, if not better, than what it was on the property that was sold, the relinquished property, just because of that rule. All right. Now, the 1031 tax savings benefit, and we've kind of already talked about that. Think back to the slide when we were talking about taxes, calculating what the taxes were, right? Remember that client sitting there thinking, hey, they're going to have to cut a check for $138,050? Again, for realtors, if that's your client and you bring that to the table, you open their eyes up to doing a 1031 exchange. It's just going to give the client that much more buying power, right? If they can do a 1031 exchange, if they can defer those taxes, now they can go out and buy a higher dollar property, right? What is that going to do for you guys as realtors? Hopefully you just increase your commissions, all right? Sometimes we even see this. Sometimes the property that's being purchased in a 1031 exchange, okay, that seller of that property is also an investor, all right? But they don't know anything about 1031 exchange, okay? Maybe if you have the opportunity, you can actually talk to them about 1031 exchange. And hey, who knows? Maybe you can pick up another transaction to help them find some replacement property, all right? Now, y'all think about this for a minute. Any property out there that is non-owner occupied is a potential 1031 exchange candidate. Why? Because if they don't live in the property, they might be holding it as an investment. Okay, there's databases that you can tap into to get those kind of leads. Okay, there's one that I know of. It's referred to as List Source. Okay, now List Source, it's actually a product of CoreLogic. Now, y'all probably have heard of CoreLogic, right? CoreLogic is a huge database company, right? They have a product called List Source. Now, within List Source, you can do searches by zip code, geographical area, subdivision, and so on. The results it'll give you, will actually give you the mailing address of that property, and it would also give you the property address. Okay, if those two addresses are different, you know they don't live in the property. Okay, you could target that mailing address to the actual owner of the property, right? Because I tell you what, we see this all the time. Somebody will own a property, right? Let's say they own a rental property, right? And they've owned that thing for years, right? And they know, boy, if they ever sell that property, they're going to be looking at a huge gain, and they're going to have to cut a check to the government, right? And you know what? They just don't want to cut that check. So what do? They just hold on to that property, not knowing that they have any other options out there. Again, if you're the one that targets that mailing address, you target the owner, right? You show to them, hey, you can do a 1031 exchange. You do have an option. Do a 1031 exchange, defer those taxes. You don't have to write that check. Now let's go out and find you something even better. Hey, who knows? Maybe they can go from having one rental property, one investment property. They do a 1031 exchange, and they might be able to buy two replacement investment properties, all right? Then all of a sudden now they have two investment properties, they have two tenants, they have two incomes coming every month. They're not so reliant on just having that one income anymore. And hopefully they make more money. Okay. Now, people tell me within the MLS system, especially here in Florida, I know that for sure. I don't know about other parts of the country so much, but here in Florida, in the MLS system, realtors tell me you'll have a product that's referred to as iMaps. You'll also have another product referred to as Remind, okay? Also, depending on the county, okay, some property appraisers' offices will actually let you do searches by absentee owners. People tell me, hey, with iMaps and Remind, you can do searches by absentee owners. Absentee owners, they don't live in the properties, right? They might be holding them as an investment, all right? So here in Florida, if any of the realtors on the line, if y'all work any of the areas with all the theme parks, right? Orlando with Disney, Universal, SeaWorld, or any realtors on the line that work any of the coastal communities, the East Coast, the West Coast, the Gulf Coast, all right, all those beach communities. There's absentee owners everywhere, right? They're in all of those communities. They might be holding those properties as investment, all right? If you've always thought, hey, I'd love to be able to start dealing with investors, but how do I get my foot in the door? Well, maybe 1031 exchange becomes a tool for you to do that, right? A tool to get your foot in the door with investors, and you have these databases, these things that are already available to you that you can go out and you can get those kind of leads. All right. So again, some things to think about for everybody on the line today, right? Now, the 1031 exchange guidelines, right? We're going to talk about the basic requirements. We're going to talk about property qualifications again. We're going to talk about the tax deferral requirements. There's some timelines everybody needs to be aware of, okay? There's also some identification rules everyone needs to be aware of, all right? So let's recap. What type of property can you do a 1031 exchange on? Any type of real property that you use in your trade or business or that you hold for investment. You can exchange it for what? Any type of like-kind property, which again is what type of property? Any type of real property that you use in your trade or business or that you hold for investment, okay? And where can those properties be located? Anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands, all right? I get this question sometimes. People will ask me, say, what about property in Puerto Rico? Property in Puerto Rico is excluded from 1031 exchange, all right? I think Puerto Rico is under a different tax structure than we are here in the States, and property in Puerto Rico is excluded, all right? Now, what types of property are excluded from 1031 exchange? Okay, so your primary home, your primary residence, right? We've already talked about that. You can't do a 1031 exchange on your primary. What do you do for your primary? Again, hey, you may qualify for that Section 121, right? Property held for sale is excluded from 1031 exchange. Now, I'll give you all an example of maybe the way that can work. Here in Florida, we have a lot of these national home builders like Pulte Homes, Lennar Homes, KB Homes. Let's say I'm Pulte Homes, right? Now, Pulte, they're one of the largest single-family residential home builders in the entire country. They're a publicly traded company. They build newly constructed properties in multiple states, right? The properties that they build, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Well, because they're holding those properties for sale and they're not holding them for investment, they cannot do 1031 exchanges on those types of properties, right? Because property held for sale is excluded from 1031 exchange, right? Now, dealer property is also excluded from 1031 exchange. Now, dealer property, that may be somebody that we most often refer to as a flipper, right? Let's say they buy a property, I don't know, 2 or 3 months goes by, and during that 2 or 3 months, they're fixing the property up, right? And when that property is completed, what do they do with it? Well, they turn around and sell it as well, right? Well, you can't do 1031 exchanges on those types of properties either, right? Because that's like their inventory. That's the business that they're in, right? They buy properties, they fix them up, and then what do? They turn around and sell them, all right? You can't do 1031 exchanges on those types of properties. Now, here's a possible solution for a flipper, all right, to be able to show that their intent was for investment. Let's say they buy a property. Again, I don't know, 2 or 3 months goes by, they fix the property up, And when the property is completed, instead of listing it for sale, they come to you. You're their realtor, and they say, hey, can you put this in the MLS system showing it for rent? Let's make sure we put it in there for fair market value rent. That's a little bit different, right? Because why? Because now all of a sudden they're showing that their intent is to hold the property for investment and not for sale. Hey, who knows? Maybe they even show it to a potential renter, right? They run some type of credit report on that potential renter. I don't know. The potential renter doesn't have such great credit, and they say, you know what? I'm not even going to rent the property to that person. Again, they have to be able to show their intent. If that flipper gets audited and the IRS comes in and says, okay, prove to us you held that property for investment and not for sale, they're going to have to be able to back it up, right? The example I gave you guys, hey, there's a good shot they would be able to back it up at that point. They could say, look, here's an email I sent to my realtor on such and such a day requesting that they put it in an MLS system for fair market value rent. Hey, here's the day I showed it to the potential renter. Here's the MLS listing showing it for rent. Here's the credit report I ran on that potential renter. All of that type of stuff is going to be their backup, right? It's going to be their proof that they held that property for investment and not for sale, right? But again, if they just buy the property and however long it takes for them to fix it up, all right, and then they turn around and sell it, they can't do a 1031 exchange on those types of properties. All right, now the next item, foreign property is excluded from 1031 exchange. Now, this might be pretty obvious, but let's say I couldn't sell an investment property located here in Florida, right? Sell that in a 1031 exchange and then try to buy replacement property, I don't know, where somewhere in like Canada or Mexico or somewhere in Europe. It has to be what? It has to be property located in the United States, including Guam, the U.S. Virgin Islands, and the Mariana Islands, right? So foreign property is excluded from 1031 exchange. All right, now, what's guideline number 2? Well, the tax deferral requirements, okay? So in order to defer your taxes 100%, to get a full deferral, okay, rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value. Now, what are the net proceeds? The net proceeds, that's the cash, okay? That's the cash that normally you would get out of the closing, all right? Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, all right? Because the rule is they can never have receipt of those funds, okay? If they do, they lose their ability to do a 1031 exchange, all right? So they can't close today and call me tomorrow and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, all right? They couldn't even close today. Leave the office, all right, the escrow company, title company, attorney's office, right where they just did the closing, get in their car, call me from the parking lot of the place they just left and say, hey, Jeff, I want to do a 1031 exchange, all right? Because their funds may be sitting in that escrow account for that company. They may be waiting to wire the funds out to them. At that point, they have what's referred to as constructive receipt, all right? They have a legal right to the funds. They've lost their ability to do a 1031 exchange, okay? So we have to get involved prior to the sale, all right? Prior to basically them walking out of the door, okay? And we hold those proceeds from the sale, okay? And then what do they need to do with them? Well, here's the rule, all right? They have to take that entire amount and they have to go out and they'll have to buy a replacement property, or it can even be multiple properties, okay, where the purchase price or the combined purchase prices, if it's multiple properties, is either equal to or greater than whatever the sales price was on the property that they sold, okay? That's rule number 1. Rule number 2 is you must acquire an equal amount or greater debt in the purchase of any replacement property or properties. Now, what exactly does that mean? What that means is if you have a loan, a mortgage that you're paying off, whatever that amount is, you're required to get a mortgage of at least that amount or greater in the purchase of any replacement property or properties. Now, that rule can actually have an exception, okay? If you have cash that you can add to the purchase of your replacement property, you can offset that rule with having to acquire any debt or any additional debt. All right, now obviously, If you have no debt, if you don't have a loan that you're paying off in the property that you're selling, okay, a mortgage, you're not required to get a mortgage in any replacement property or properties, but you do have the option, okay, if you want to or if you need to help you purchase that replacement property, by all means, you always have the option to get a loan to help you purchase that replacement property. All right, now here's some quick numbers of how it can work. All right, quick example. Okay, in our example, we're going to sell our property, the relinquished property, for $1 million, right? So we'll take that $1 million sales price, okay, and we actually have some debt that we're paying off, right? We have a mortgage that we're paying off, and the payoff amount is $300,000. So we'll take that $1 million sales price, we'll deduct out the payoff amount of $300,000. Now, we have some cost of sales associated with the closing, all right? Let's just say that's $50,000. That's going to be like real estate commissions, title insurance, closing fees, some of those non-reoccurring type of fees. Again, let's just say that's $50,000. So we'll take out that $50,000, and then that's going to give us net proceeds of $650,000. Now, again, we're the qualified intermediary, the QI. Okay, we're going to hold that $650,000 on behalf of the seller, all right, the exchanger, because again, they can never have receipt of that $650,000. If they do, they lose their ability to do a 1031 exchange, right? So what are they going to do with that $650,000? They're going to use that entire amount, and in this example, they're going to use that, and they're going to go out, and they're actually going to buy a property of greater value, all right? They're going to buy a property for $1.2 million, all right? Now, they still need another $550,000 to help them buy that property for $1.2 million. So what do? Well, in this case, they get a loan for $550,000. All right. By doing that, they actually obtain greater debt, right? Because they had a loan for $300,000 that they paid off. That was the payoff amount, and they actually got a new loan for $550,000. Right. So in this example, they get a full deferral, right? Because they used all the $650,000. They actually bought a property greater in value, the $1.2 million, and they actually acquired greater debt, right, by getting a loan for $550,000. So they get a full deferral. Now, remember with rule number 2, the debt amount, right? Let's just say they didn't want to get a loan for $550,000, okay? Let's just say they actually had $550,000 cash that they were willing to put towards the purchase of their replacement property, okay? They could have done that and still met that rule, all right? Or they could have even done this. What if they said, well, we don't have $550,000 cash, so we don't feel comfortable putting that amount up. We do have some cash that we're willing to put towards buying the replacement property, and then the difference, we'll make that up in a mortgage. They could have done that as well, all right? So any of those scenarios work for rule number 2. All right, now what if they wanted to do this? What if out of the $650,000 they say, well, we don't want to use all of that towards buying replacement property. We want to hold some money back. Let's just say they want to hold back $100,000, right? That amount they're going to put in their pocket, right? Now they can do whatever they want with that amount, that $100,000. They want to pay off bills. They have a child starting college. They want to go on a great vacation. I don't know. They want to go to Vegas. They want to blow it all gambling, right? Whatever they want to do with that $100,000, they can do, all right? But they're going to be subject to taxes on that amount, all right? It's referred to as cash boot, all right? Doesn't mean they can't do a 1031 exchange, okay? It just means that instead of them getting a full deferral, they're going to get what's referred to as a partial deferral. Now, partial why? Because they're going to be paying some taxes on the boot, all right? So we actually hold $550,000, right? And what are they going to do with the $550,000? Well, they're going to take that amount, and they're actually going to use that amount to go out and buy a property of less value. So they're going to buy a property for $800,000. All right. Now, they still need another $250,000 to help them buy that property for $800,000. So what do they do in that case? Well, they go out and they get a loan. They get a mortgage for $250,000. But by only getting a loan of $250,000, right, they actually go down in debt by $50,000, right? they're actually going to be subject to taxes on that amount as well, that $50,000. That's referred to as mortgage boot. All right, so there's two types of boot. There's mortgage boot and there's cash boot. Again, doesn't mean you can't do a 1031 exchange. It just means that you're going to get a partial deferral instead of a full deferral. Now, typically, the tax that you pay on the boot, all right, is going to be significantly less than if you just sell the property outright and you don't do a 1031 exchange. All right. If anybody ever wants to do anything like this, always tell them, I say, look, talk to your CPA because you really need to know your numbers, right? You have to look at it and say, okay, if I don't do a 1031 exchange and I just sell the property outright, well, what do my taxes look like? But if I do a 1031 exchange, all right, and I take out some boot, maybe mortgage boot or cash boot or both, all right, what do my taxes look like on the boot, right? Again, typically that tax is going to be less than if you just sell the property outright and you don't do a 1031 exchange. But if the CPA comes back and says, you know what, the taxes that you're going to pay on boot is actually going to be greater than if you just sell the property outright, well, guess what? Don't do a 1031 exchange, okay? It's not going to be worth your while. You're going to lose money. So again, always, always, always talk to the CPA and make sure you know your numbers before you do anything, all right? So that's boot. All right, now, so guideline number 3, there's some timelines everyone needs to be aware of, right? So from when you sell your relinquished property, right, from the closing date, from that point forward, you're going to have 180 calendar days to purchase any replacement property or properties. And that's calendar days, folks. That's holidays, that's weekends. Okay, next Monday is the July 4th holiday. That's included, all right? Hey, we live in Florida. I live in Florida. Most people on the line today live in Florida. If we're getting hit with a hurricane and everything shuts down for a day or two or a week, that doesn't even matter, all right? There's some type of natural disaster. It doesn't matter. The clock is always going to be ticking, all right? So it's 180 calendar days to purchase any replacement property or properties, okay? The first 45 days of the 180 days is referred to as the identification period. Now, what exactly does that mean, right? Well, the identification period means is you must identify any potential property or properties that you want to purchase, okay? They don't have to be under contract. You just have to identify any potential properties that you want to purchase, all right? That's something else that we're going to assist with, right? We're going to provide a form to the client, the exchanger, all right? That form is referred to as the identification ID letter. And on that form, there's going to be some blank lines, okay? And it's going to have to be specific to a property address or addresses, okay? The client's going to have to fill it out, sign off on it, get it back to us by midnight of the 45th day, okay? That's how they will formally identify their replacement property. They're going to do it to us, the qualified intermediary, okay? But here's the thing with the 45 days, okay? Let's just say they find the perfect property and it's day 46, okay? At that point, it's too late, all right? So whatever they put on that form, by midnight of the 45th day, they're going to have to make sure that they're going to be able to purchase at least one of those properties by day 180, okay? If they're purchasing the property and it's day 181, unfortunately, they're paying all their taxes, all right? If they don't identify any properties by midnight of the 45th day, they're paying all their taxes, all right? If and let's just say they list 3 properties on the form by midnight of the 45th day, right? After midnight of the 45th day, one of those properties sells, okay? One of those properties burned down to the ground. What that means is they only have the opportunity to purchase that one other property. There is no exceptions. There's no going back saying, well, those 3 properties that I listed, well, one of them just sold. I could never possibly buy it. Or it just burned down to the ground. I could never possibly buy it. It doesn't matter. Okay, it's very strict. There is no exceptions to those rules. You have to purchase your replacement property by day 180 after you close. And the first 45 days, you have to identify any potential property or properties that you want to purchase, all right? So keep that in mind, the 45 days and the 180, all right? Now, guideline number 4. There's some identification rules as far as identifying property. All right, there's three different rules. Right now, I'm going to read each one of the rules to you. Okay, and if you don't quite understand them when I read them to you, don't worry about it, because I'm going to walk you through the numbers, examples of how each one of the rules work, and hopefully, once I show you the examples, it's gonna make sense to you. All right, now, the most popular rule that we see investors enacting is referred to as the three property rule. All right, the three property rule states this: you can identify up to three properties without regard to the fair market value of those three properties. So what exactly does that mean? Fair market value, right? What that means is if you identify three properties or less, okay, the purchase prices of any of those properties can be any dollar amount. It does not matter. Okay, as long as it's three properties or less, the purchase prices can be any dollar amount. Now, if you want to identify more than three properties, well, you can do that. Okay, but it's going to put you into this next rule. Okay, it's referred to as the 200% rule, and the 200% rule states this: you can identify over three properties, but you cannot exceed 200% or two times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, what that means is if you identify more than three properties, okay, the combined purchase prices of all those properties that you've identified cannot exceed 200% or two times whatever the sales price was on the property that you sold, okay, the relinquished property. All right, now, if you want to identify more than three properties, you also want to exceed the 200% rule. Well, you can do that as well, all right, but you're going to fall into this next rule, all right? It's referred to as the 95% rule. Now, it's very rare that we see investors even enacting this rule, all right? It doesn't make a lot of sense the way it's written, all right? But just remember this: it's the IRS, folks. And sometimes this stuff just doesn't make sense, okay? Because it reads like this: you can identify over three properties. You can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you have identified. All right, now I know that's probably about as clear as mud, right? Like I said, it doesn't make a lot of sense. Let me show you all the examples, especially with this last one, the 95% rule. And hopefully, once I show you the example, it'll make sense to you. All right. So here we go. Here's the three property rule again. Again, the three property rule states that you can identify up to three properties without regard to the fair market value. Right. So the purchase price can be any dollar amount. Right. So here's an example of the way it can work. Let's say we sell a property for $1 million. Right. Now, in this case, we actually go out, we identify three properties. All right. Because we've identified three, we're in the three property rule. Right. And let's just say we're going to buy each one of those properties for, I don't know, $1 million each. So we identified how much in property? $3 million worth of property, right? Now we could be buying each one of those properties for $10 million each for a total of $30 million in identification. Again, it doesn't matter. As long as it's three properties or less, the purchase prices can be any dollar amount. It does not matter. But what does matter, and I'll say it again, if you identify three properties, boy, you better make sure you're going to be able to purchase at least one of those properties, right? So what's the best way to lock up a property? Well, it's to put one of them under contract, right? Well, that's typically what we see. In practice, investors will put one property under contract, and maybe that's one of the ones they identify. Then, I don't know, maybe they'll identify two other properties, okay? Because, again, if after midnight of the 45th day, if that property that they have under contract, if that contract happens to fall apart, okay, at least they have the opportunity to purchase those two other properties that they would have put on the form that they would have identified, right? So again, that's how the three property rule works, right? Now, here's the 200% rule. Again, this is where you exceed the three property rule, but you cannot exceed 200% or two times the combined fair market value of the property being sold. So again, here's how it works. Okay, again, we sell for $1 million. Now, we go out and we identify five properties, okay, because we've identified five. Well, what just happened? It put us out of the three property rule, right? Because we've exceeded it. That put us into the 200% rule, right? So in this example, all right, the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you may be asking yourself, where's it getting the $2 million from, right? We sold for $1 million, right? So 200% of that $1 million sales price, or 2 times that $1 million sales price, is how much? $2 million, right? So that's where we're getting the $2 million from, all right? So I think this is pretty straightforward. Hopefully everybody gets it, all right? Now, if you want to exceed the 3-property rule, you also want to exceed the 200% rule. Well, you can do that, right? But it's going to put you into this rule, the 95% rule, all right? And the 95% rule states that you must acquire at least 95% of the value of all the properties that you've identified, all right? So here's how it works. Again, we sell for $1 million, right? Now, in this example, we go out and we identify 10 properties. Because we've identified 10, well, what just happened? We've exceeded our 3-property rule, right? Now, let's keep the math really simple for this one. Let's say we're going to be buying each one of those properties for $1 million each. So how much have we identified in property? $10 million worth of property, right? Because we've identified $10 million worth of property, what just happened? We've exceeded our 200% rule, right? Because that was how much? $2 million, right? So that puts us into the 95% rule, okay? So in our example, let's just say we only acquire 9 out of the 10 properties, right? That's only 90%, right? Or $9 million. That's not 95%, right? If we do that, if we only acquire 9 out of the 10 properties, guess what happens? We blow our entire exchange and we have to pay all of the taxes, right? So the reality of the 95% rule, really the way it works is 100% of whatever you identify, you're going to have to buy, all right? And we're using really simple numbers, right? We're saying, hey, everything's going to be $1 million each. You know, the reality of the way that's going to work is those purchase prices, they're going to be all over the map, right? It's going to be really, really hard to sit down and say, okay, let's see. If I get this property, wait, that's only going to put me at 93%. All right, maybe I need to make sure I purchase this other property. Wait, that's only going to put me at 94%. All right, the 95% rule is really 100% of whatever you identify, you're going to have to buy. All right, the IRS wants to limit you in how many properties you can identify. You know what? They don't want you identifying everything under the sun, because you know what's going to happen? If you identify everything under the sun, you're going to have to buy everything under the sun because of this crazy 95% rule. All right. Hopefully everybody gets this. Like I said, we don't see it enacted that much, that often. But again, remember, it's out there. Okay. Now, how does the whole closing process work with 1031 exchange? All right. So, we really don't start doing our thing until a contract gets signed on the property being sold, right? Because the way the process starts is I need to get a copy of that contract, all right? I also need to get the contact information for whoever's going to be handling the closing, okay? Because what happens is we're going to reach out to that company, all right? And we're going to get from them a copy of the title search, the title commitment, the title bonder, right? It just depends on what they call it in different parts of the country, but basically it's a search of the title. All right. Once we get that in, along with a copy of the contract, okay, then what we're going to do on our end is we're going to prepare what we refer to as an exchange agreement. All right. And those are going to be documents that are going to set the exchange up. Right. We're going to email those over to whoever's going to be handling the closing, the escrow company, title company, attorney. Okay. They're going to be sitting there waiting for the closing to happen. Day of closing, the seller is going to come in. They're going to sign those documents, right? That's going to give us the ability to step in their shoes as the seller, okay? And whoever's going to be handling the closing, they're going to wire those net proceeds over to us, and we're going to hold them on their behalf, all right? That transaction is completed, right? From that point forward, then what happens? Then the clock starts ticking, right? 180 days to close. The first 45 days of the 180 is the identification period. We're going to be sending out the identification ID letter. Client, exchanger is going to be completing it, signing off on it, getting it back to us by midnight of the 45th day. All right. Now, once they get a contract on whatever replacement property they want to purchase. We'll need to get a copy of that contract as well. We'll also need to find out who's going to be handling that closing. Chances are it's going to be somebody different, a different company, right? Because think about it, we're going to be holding all their funds from their sale. We're going to need a contact person at that company that's handling the closing of the purchase. We're going to need to get that company's wiring instructions. We're going to prepare some other documents that they're going to sign at the purchase of their replacement property, okay? Because in that transaction, we're going to step into their shoes as the buyer. And that's going to give us the ability to take the proceeds that we've been holding from their sale, all right? And we're going to wire those funds over to whoever's going to be handling that closing to help them purchase their replacement property. All right, that's it. That's the entire closing process. All right, it's not that complicated of a process when it comes to the actual closing. Just everything leading up to it is the complicated stuff, right? Trying to figure out what you want to buy by midnight of the 45th day, negotiating the contracts, applying for a loan, figuring out if you need to add cash. All that type of stuff is the complicated stuff. When it comes to the actual closing process, well, that's probably the easier part of the 1031 exchange process. All right. Now, everything we've talked about today, okay, is referred to as a delayed exchange, right? It's the most common type of exchange that we do. All right. It's where you sell first. You sell your relinquished property first, right? Clock starts ticking, 45 days to identify, and you're purchasing your replacement property last. You're purchasing that replacement property by day 180. Okay, that's referred to as a delayed exchange. It's the most common type of exchange we do. I don't know, 90 to 95% of all the exchanges that we do fall under the delayed exchange. But there's a few other type of exchanges I want everybody to realize that are out there. Okay, there's another type of exchange. It's referred to as a reverse exchange. Now, the reverse exchange works just the opposite of a delayed exchange. It's actually where you buy first. You buy your replacement property first, and then you sell your relinquished property last. Okay, they can work something like this. Let's say you have your property listed for sale. Now, maybe you don't even have an offer on it yet. You don't even have a contract on it yet, right? But you go out and you find the perfect replacement property, okay? And let's just say it's a seller's market, all right? It's a market like we have right now where properties are turning over really fast, okay? And you know, boy, if you don't act fast, you're going to lose out on being able to purchase that perfect replacement property. Because why? Because, hey, it might get sold before you sell your relinquished property. So what can you do? Well, you can do this thing called the reverse exchange, where the way the reverse works is we actually come in and we form a separate company, all right? It's referred to as an exchange accommodating title holder, EAT for short. We come in and we purchase the replacement property before you sell your relinquished property, okay? Now, from when we do that, from when we purchase the replacement property, you must be able to sell your relinquished property within 180 days, all right? So there's the 180 days coming back into play, okay? It never leaves. It's always going to be there in some form or fashion, okay? You must be able to sell your relinquished property within 180 days. Now, what are some of the positives for a reverse exchange? Well, again, as I mentioned, in a seller's market where you have to act fast, you find that perfect replacement property, you want to jump on it, you can do the reverse exchange. Now, what if you did this? Now, some realtors on the line, you may have had clients like this in the past, so maybe you have one currently. They list their property with you, right? And they list it with you and they think, boy, I have the greatest property in the world, right? I'm not going to have any problem selling that property. And what do? They go out and put a contract on a replacement property. And then slowly but surely, what happens? Well, reality starts to set in, right? The client realizes, hey, maybe I don't have the world's greatest property. Because why? Because, hey, I'm not getting all those showings like I thought. I'm not getting all those offers like I thought. But guess what? You already have a contract on a replacement property, and that closing date is fast approaching, right? You're obligated to buy that property. How do you save that whole deal? Well, you can do the reverse exchange and save the whole deal. Now, what's the negatives? What's the biggest obstacle to overcome in a reverse exchange? Well, you know, we're a great company, all right? But we're not just going to come out of pocket and buy the replacement property, okay? The client is going to have to be able to give us the financing to be able to do that. All right. Now, typically, it's going to have to be cash. Now, why do I say cash? Because if the client's trying to get a loan, okay, and they're trying to get a loan through a traditional lender or a traditional bank, typically lenders, banks at that point, they're not going to loan funds at that point, all right? Because why? Because, hey, we're not the borrower, the client is. We're actually going on title, the client is not. So that's why I say typically they're going to have to be able to come up with the cash in order for us to purchase that replacement property. All right, now, hey, maybe they have some kind of great banking relationship. They can get some type of line of credit, something like that. Now, people tell me some of these hard money type lenders, boy, they'll do deals like that all day long. For us, it doesn't really matter. Just some way, somehow, the client's got to be able to give us the financing in order for us to purchase that replacement property. Now, what's the other negative? Well, I've already mentioned it. You got to be able to sell your relinquished property within 180 days, okay? What happens if you don't sell your property within 180 days? Well, you're going to own two properties. Okay? We're not going to hold on to it. We're going to transfer the property back over to you, and you're going to own two properties. Now, you're not going to have any capital gains taxes or any other taxes associated with the sale because why? Because you never sold anything, right? Now, ultimately, if you say, well, hey, I still want to sell that investment property, no problem. You can do that, all right? You can do a 1031 exchange, but you're going to have to designate a new replacement property. Because why? Because at that point, you would have already owned the original replacement property, okay? And with 1031 exchange, you can't exchange into something you already own, all right? So keep that in mind, all right? That's referred to as a reverse exchange. Now, there's another type of exchange. It's referred to as a construction exchange. Another term you may hear people refer to it is an improvement exchange or a built-to-suit exchange. They can work something like this. Let's say you sell your relinquished property. You sell it in a 1031 exchange, right? Now, we're the qualified intermediary, the QI. We're going to be holding the proceeds from that sale, right? Now, the client goes out, and let's say they find a replacement property, but they want to do some improvements to it before they actually acquire it. So what can they do? Well, they can do this thing called a construction improvement, built-to-suit exchange, okay? Again, we come in, we form that EAD again, right? The exchange accommodating title holder. We take the proceeds that we've been holding from the sale of the relinquished property, and we can use those proceeds, and then we buy the replacement property, okay? And then we oversee any construction, any improvements, okay, to the property. All right, now we're going to be working with the contractors. We're going to be handling any disbursements to the contractors. Now, we're getting input the whole time from the client, the exchanger, okay? Now, those improvements need to be done within 180 days, all right? There it is again. As I mentioned, it never goes away, folks. It's always going to be there. Those improvements need to be done within 180 days, okay? So that's referred to as a construction improvement or built-to-suit exchange. All right, now, there's another type of exchange. Now, I call it a non-appreciation exchange, okay? Because sometimes, you may have a client that says, you know what, I bought my property in the height of the market. Okay, let's say they bought their property for $1 million, right? Now, they've owned it for years, okay? And then the client tells you, they say, well, I'm going to sell the property, and I'm selling it for $1 million, right? Well, on the surface, it may look like they have no gain, right? They have no reason to do a 1031 exchange because, hey, they're basically selling it for what they bought it for. But think about this. You remember depreciation recapture tax, right? That 25% tax. There could be a potential issue there, right? Because let's just say in the example, they took $200,000 worth of depreciation for the lifetime that they own the property. Okay, so what's going to happen is when they go to sell the property, they're going to be hit with a 25% depreciation recapture tax on that $200,000 worth of depreciation that they took for the lifetime that they own the property. That's going to equate to $50,000 in taxes, all right, depreciation recapture tax that they're going to incur when they sell the property. They can still do a 1031 exchange, okay, in that case, and defer the depreciation recapture tax, all right? So for realtors, Don't always think. If the client's sitting there saying, "Hey, I'm selling it for what I purchased it for. I have no gain. I have no reason to do a 1031 exchange." Just ask them. Say, "Look, have you talked to your CPA? Do you know your numbers?" All right, because you don't want them to be in for a shock when they sell that property, not realizing, hey, they could have done a 1031 exchange and deferred all their taxes, whatever tax was due. All right, now another red flag could be this: if you ever have a client that says, "Yeah, my investment property that I'm selling, I purchased it years ago in a 1031 exchange, but you know what? I don't want to do another 1031 exchange. I'm just going to cash out." Remember, 1031 exchange is a tax deferral, right? They're going to be subject to taxes on that particular sale, and any of those deferrals that they did prior to that, right? They may also be subject to having to pay those taxes as well. Okay. Now, what do we charge? What's our fees? Well, for a delayed exchange, right? Again, that's the most common type of exchange, right? That's where you sell first, all right, and you buy last. You're buying your replacement property by day 180, all right? We charge a flat $1,250. Okay. What that covers is it covers the sale of one property and the purchase of up to 3 replacement properties. Now, our fee, that fee doesn't actually get incurred until the day of closing. Okay. Realtors, you don't earn your commission until the day of closing. All right. If we get everything set up, I just walked y'all through the entire closing process, right? We like to get started once the contract gets signed. We get the exchange documents prepared, everything's sitting at the title company, escrow company, attorney's office, waiting for the documents to be signed. If the whole contract falls apart, if it never gets to closing, we don't charge any kind of cancellation fees, all right? We don't charge any type of setup fees, wiring fees, okay? Our $1,250, our fee is not incurred until the day of closing, all right? Day of closing, we charge the $1,250, and again, what does that cover? It covers the sale of the one property, okay, and the purchase of up to 3 replacement properties, okay? That's on the delayed exchange. Now, the reverse exchange, okay, again, that's where you buy first. You're buying your replacement property first, and you're selling your relinquished property. Those can be significantly more complicated than a delayed exchange, okay? Our fee for those start off at about $6,500. We're forming a separate company. We're going on title, okay? Those are about $6,500, the starting point. The construction exchange, improvement, built-to-suit exchanges, right? Those start off at about $6,500 as well. With those, we're going on title. We're also working with contractors. We're overseeing construction. Okay, those can be significantly more complicated than a delayed exchange. Remember in the very beginning, I told you guys, one of the owners of our company is a tax attorney, Adam Skarsgård. Adam personally handles any reverse exchanges or construction improvement exchanges, built-to-suit exchanges that we do, okay? Because he looks at each one of them individually and bases our fee on how complex it can be, okay? All right, that's it. We're done as far as the slides go. I'll go ahead and open the floor up to questions. All right, if you have any questions, please feel free, type them in. On the box, there's a box on the right-hand side says questions. Feel free to type them in right now. And as we're waiting for questions to come in, I'll remind everybody again, I said this in the very beginning, but today's presentation was recorded. Okay, you're going to receive a link to today's recording. All right, if you want to refer back to any of the topics. Also, some of the topics, I mentioned it here and there, throughout the presentation. I have in just single page PDFs, okay? I'm going to email those out to everybody. Some of my information I actually have in Spanish and I even have in Chinese. If you want those additional languages, please let me know, okay? I'll be glad to email those out to you. Also, don't feel like you have to be a 1031 exchange expert. Okay, I want to be a resource to all of you guys, all right? If you have clients that have 1031 exchange needs, please let me know. I'd be glad to talk to your clients. If you individually, if you're an investor yourself, I'd be glad to talk to you about any 1031 exchange questions you may have, all right? My contact information is up on the screen. Please feel free to just give me a call or shoot me an email. We can definitely talk. Today's class was worth it was a 2-hour class. Obviously, it was 2 hours of continuing ed just for Florida realtors. Okay, if you're on the line still, you got the credit. If you people that had to join had to leave early, unfortunately, I can't give them the credit. Okay, the state of Florida requires that you participate for the entire duration of the class. All right. I do have two other classes that I teach. I teach a 1 hour basics class. It's non-CE. I also have an advanced 1031 strategies class. That's about an hour and 15 minutes. That's another non-CE class. If you'd like, if you're a realtor, if you think other realtors in your office would benefit from one of those classes, or even this class, the 2 hour class, all right, the Discovering 1031 Exchange class, let me know. All right, I do a lot of individual presentations for real estate offices, boards of realtors, title companies, attorneys' offices, CPAs. Let me know. I'd be glad to set up something with your individual offices so everybody else in the office can benefit. We can do the 1 hour, either the basics or the hour and 15-minute one, the advanced. If you want to do the 2 hour, we can do this one. If it's for realtors in Florida, they'll pick up 2 hours of continuing ed. Okay. So let's see. Do we have any questions coming in? All right, Tony, you're welcome. I said very informative. Thank you. Thanks for attending. And if you do have a question when we finish today, if it pops up afterwards, I know sometimes it's hard to type in a question in like 20 seconds, especially if it's complicated. Again, give me a call. Shoot me an email, more details. I definitely would want to talk to you. Okay. All right. Doesn't look like any other questions are coming in. All right. Well, just again, let me know. I do have, I offer this class once a month. The other two classes, the basics and the advanced class, I offer those once a month. I always do them through the same go-to webinar, this platform. I haven't decided on the ones I'm doing next month, but be on the lookout if you want to attend the basics or advanced or have other people that you want to let them know about the classes. Be on the lookout. If you got the information about the registration for this class, you'll get the information once the classes, the dates are decided for next month. And feel free to join in, or anybody else you want to forward it on to, feel free to send it on to them. All right, well, great. I guess we'll go ahead and wrap it up. We're just about out of time today, but again, thanks for joining today, everybody. Today is almost the end. It's the last day of the month, so if hopefully you have a good month and enjoy your weekend, and please stay safe, stay healthy, everyone, and hopefully we'll talk soon. Thank you. Bye-bye.